episode of Palisade Radio. We're continuing our interviews here at the Palisade Jekyll Island Conference. Sitting down with me, you probably recognize him, Adrian Day. He's the head of Adrian Day Asset Management. Thanks so much for coming down.
Well, thank you for having me. Thank you.
Yeah, it was an excellent conference. We're starting to wind down now and come to an end, but you were the final speaker yesterday, and we did that intentionally because we had a whole bunch of different topics going on, but you're an asset manager, and I wanted to bring the discussion back to where is gold and gold stocks going over the next few months. What did you have to say?
Well, I talked a little bit about some of the problems with the gold mining, both the gold mining companies and the gold mining stocks, because it is a difficult business, and a lot of people don't realize, I think, just what a inherently difficult business it is. You know, high capital costs, low odds of success if you're exploring, fixed assets that can be taxed or confiscated. So there's lots of problems in this as an industry if you compare it with other industries. But my conclusion, when you look at the gold stocks, not only is gold itself cheap relative to the broad stock market and other financial assets, bonds for example, but gold stocks are extremely cheap relative to gold. You know, frankly, I think this is, you know, the fifth biggest opportunity we've had in the last 30 years to buy gold stocks.
Adrian, you were managing assets, of course, from 2000 to 2007 when we endured on a very memorable bull market for the gold stocks. Do you feel that we have similar opportunity at this point as to what started then?
I do, but for different reasons or some different characteristics. And one has to say, as the SEC always tells us to say, you know, the past is not a predictor of the future. Of course it isn't, but as Winston Churchill once memorably said, it's a way to bet. So the bull market of the early 2000s, of course, was prompted by the growth of China, the rapid rise of China, and you saw that both in the industrial metals, the base metals, but also in gold, where, you know, an emerging middle class in China now had more money to buy gold. I don't think that's going to be the story going forward. I do think that China's economy is likely to recover from the slowdown it's had, and remember, when we use the word slowdown in China, it's a relative slowdown. You know, if we could have 6.5% to 7.5% growth, we'd be ecstatic. We wouldn't be complaining about a slowdown. I think the recovery in China is definitely going to help because it brings more buyers in. But I think the biggest story going forward is just the shortage of new deposits that are available. Remember, gold mines are depleting assets. If a gold mining company produces 5 million ounces last year, they have to find or acquire 5 million new ounces, and in fact it's more than that, as you know, because of depletion, because of you know, waste. But they have to find 5 million new ounces every single year. When you add up all the production that we have, we are simply not finding enough ounces to replace what we're mining. And that story is likely to be true for the next, you know, 5, 7, 10 years. Almost regardless of the price, because of course if the price goes up, yes, there are some mothballed assets that we can bring back into production, there's some expansions we can do, and certainly there's mines that are at the end of their life that maybe we can drag on for another year or two. So yes, if the price goes up, there is some increase in production, but you can't bring a major new mine into production just because gold goes to $1,800. It takes many years. It takes several years of exploration and development, as you know, and then it takes years of permitting, and then it takes time to raise the capital. So one can say, one can look at the exploration in the last 10 years or 10 years ago. One can look at projects that are in development right now, and importantly, which we always forget, you can look at the major mines that are currently depleting because they're reaching the end of their mine life. And one can be reasonably sure that over the next, you know, 5, 7 years, the production of gold will decline. And obviously that's a positive for the gold price.
So one thing you didn't talk about yesterday, Adrian, in the discussion, but something I find very interesting and we talked about on the radio show last time, is that the gold stock investors are very weary of what happened in 2008, which is when the Dow crashed, so did the gold stocks. And you have some evidence to suggest that might not happen this time.
Might not, yes. I think it's true to say, but generally speaking, if a broad market falls, it takes everything down with it. And in 2008, you're quite correct, we all remember, only too painfully, the gold stocks crashed. But I think it's important to remember that a lot of people seem to have forgotten that gold and then the gold stocks came back much sooner than the broad market did in 2009. And in fact, we had a very good rally in the gold stocks from 2009 to 2012. I think one of the things you have to look at when you're asking the question, if the broad market drops, will gold stocks drop as well? You have to look at how cheap are the gold stocks and did they participate in the previous rally. So you look at 1986-87, before you were still in short trousers then, right?
Not born yet.
Not born, okay. So in 86-87, you had a very strong market in the broad market, but the gold stocks fully participated in that. So that in October 1987, when the broad market crashed, the gold stocks were, on any objective basis, overvalued. You simply cannot say that today. And of course in 2007, the gold stocks had run up in the previous years. If you look at the gold stocks today, A, they have not participated in the broad market run-up, and B, they are, by any objective standard, cheap. They are not expensive. So I think, historically speaking, if you look back, there's every reason to think that if we had a crash in the If you have a crash in the stock market, the gold stocks will go down immediately, but they will probably rebound much, much, much sooner than the rest of the market. And if you have a slow decline, you're more likely to see rotation from the expensive sectors into the cheaper sectors, such as gold and gold stocks.
Well, I think listeners will find that not just reassuring, but also quite exciting news that we could finally be in the right spot after a few years of feeling like we're going against the current. Adrian, thank you so much for coming to the conference, and I appreciate you speaking and being on the show again.
Thank you very much for having me. It was a great conference. I enjoyed it.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?